Today, we are taking aim at a myth that has held countless investors back, the notion that only big investments bring big returns. So, many people think you need to pour in huge amounts of money, tens of thousands of dollars, just to see substantial gains. They assume if they don't start with a large sum, they'll never get anywhere near beating a standard benchmark like the S&P 500. But is that really the case? Before we go further, let's clarify what we're talking about and what we're not talking about. We're talking about the power and potential of small stock market investments, relatively modest sums of money that can, when chosen wisely, outperform much larger investments. We're talking about leveraging knowledge, strategy, and discipline to identify high potential companies early on, even if you only invest a few $1,000s. What we're not talking about is gambling on penny stocks with zero fundamentals or chasing every hot tip on social media. We're not talking about get rich quick scheme. We're discussing a thoughtful research based approach to investing that allows even a busy professional like you to get better returns than just mindlessly following an index. By understanding this, you open the door to a world of opportunity that doesn't require you to put your entire net worth on the line. In this video, I'll break down what great returns on investments really mean. I'll show you why small investments can still yield exceptional gains. And I'll present examples, address your concerns, and guide you through the right and wrong ways to approach this. Stick around because by the end of this video, you'll have a new lens through which to see your investing journey. And what are great returns on investments? Let's define our terms. We often measure our performance against the S&P 500, a benchmark for the US equities market. Over the long term, the S&P 500 trends to return about 8 to 10% per year on average. If your portfolio can consistently achieve returns above that, say 12, 15, or even 20% or more annually, you are doing extremely well. Such returns compounded over time dramatically increase your wealth compared to just passively following the index. Now, what's not great? If you're working hard and you're still not beating the S&P 500, you're essentially leaving money on the table. The S&P 500 is a broad market measure. It doesn't necessarily pick winners. It just averages out performance across many companies. If you're picking individual stocks, you have the opportunity to identify growth earlier. Why settle for average if you can do better? There's a widespread myth that you need a substantial amount of capital to invest before you can expect meaningful gains. The thinking goes that if you only have a small amount, even a successful pick won't yield enough profit to matter. But consider this. What if that small initial investment could double, triple, or even increase tenfold over a span of a few years? If you start with $2,000 and it becomes $20,000, that's a significant jump. If you replicate that success a few times, you're dramatically improved your overall portfolio returns, potentially outpacing broad market indexes. Part of the reason this myth persists is psychological. We often equate big with important. Large investments seem more serious, more substantial. But big returns are really about percentages and growth rates, not the absolute size of the initial stake.